Hey everyone, and welcome to this explainer. Today, we're going to unpack the incredibly fascinating and, yes, slightly complex architecture of a developing nation's banking system. To really wrap our heads around this, we'll be using the financial frameworks of Pakistan and Bangladesh as our blueprints. We're going to see exactly how these massive financial machines are built from the ground up to support millions of people and ultimately drive national growth.
Okay, let's take a super quick look at our agenda. We'll start with the economic engine, then move into commercial and Islamic banking, cover funding for long-term growth, break down scheduled versus non-scheduled banks, and finally, look at the big push for financial inclusion.
Right, let's dive straight into Section 1, the economic engine, focusing specifically on the role of the central bank.
So think of a central bank like the State Bank of Pakistan as the absolute brain and heart of the entire economy. It acts as the ultimate conductor. It's really not just a bank for the government. It's the powerhouse that actually formulates monetary policy and manages foreign exchange reserves. Its number one job? Ensuring national financial stability, keeping inflation in check, and maintaining public confidence in the whole banking system. Because let's be real, without a strong central bank, economic development would be almost impossible to sustain.
And it pulls this off through some serious heavy lifting. Now, it's not just about printing money, though. As you can see, issuing currency is definitely on the list. The central bank strictly supervises the entire commercial system. It enforces capital adequacy, which basically means making sure banks actually have the money they say they have, and it oversees deposit protection. This means if a bank somehow goes under, your eligible deposits are protected. That right there is an incredible anchor for public trust.
Moving right along to Section 2, Commercial and Islamic Banking. These are essentially the main arteries of the economy.
Private commercial banks make up the largest chunk of the banking system. Just look at this data from Bangladesh. Out of 40 private commercial banks, 8 are Islamic Sharia-based. This highlights a massive, rapidly growing demand for Sharia-compliant financial services that operate right alongside the conventional, interest-based banking sector.
Now, this distinction is absolutely vital. Unlike your conventional commercial banks that run on a strict profit and interest basis, Islamic banking is anchored by its own unique core principles. The biggest foundational rule is the total avoidance of riba, or interest. So instead of just charging interest on a loan, these institutions use profit and loss-sharing models and asset-backed financing. The risk and the reward are fundamentally shared between the bank and the customer.
So how does that actually look for everyday people? Well, here are some of the most popular Islamic banking products. You've got Islamic savings accounts, specialized financing models known as Murabaha and Ijara, and structured Islamic home and auto finance. Through these specific products, consumers and business owners can securely finance a house or scale up a business while strictly adhering to Sharia law. And yep, it all happens while remaining under the watchful eye of the central bank.
But an economy is way more than just checking accounts and car loans. That brings us to Section 3, funding long-term growth through specialized financial institutions.
Beyond your everyday banking, a developing economy really needs specialized organs to fund the big stuff. That's where development finance institutions, or DFIs, step in, precisely where regular commercial banks might get a little hesitant. They provide the long-term loans required to build massive energy grids, fund large-scale agricultural expansions, and fuel the kind of heavy industrial growth that powers a nation's long-term future. They're basically the heavy lifters.
Meanwhile, on the complete other end of the spectrum, we have microfinance banks. If DFIs are the massive arteries, microfinance banks are the essential capillaries of the economy. They reach deep into rural and underserved urban areas to provide small loans, micro-savings, and micro-insurance to low-income individuals. By directly funding grassroots entrepreneurs, they act as an active driving force in poverty reduction. It's really impactful stuff.
So, how on earth is all of this categorized and regulated? Let's get right into the rulebook in Section 4, Scheduled versus Non-Scheduled Banks.
In places like Bangladesh, banks are categorized by a really fascinating distinction: control and enlistment. Scheduled banks are fully integrated and enlisted under the central bank's umbrella, meaning they operate under its full, direct control. Non-scheduled banks, on the other hand, are established for special, definite objectives and operate with much more limited central bank control. Because of that, they just can't perform all the functions of a regular scheduled bank.
Functionally, the differences between the two are pretty stark. Because scheduled banks operate under the full control of the central bank, they get some massive privileges. We're talking access to clearing facilities and direct central bank loans.
Non-scheduled banks, they completely miss out on these. To even clear a check, a non-scheduled bank literally has to go through a scheduled bank.
But, as we know, privilege comes with serious responsibility. Scheduled banks face incredibly strict obligations. They're required to submit weekly performance statements, and they face hefty reserve requirements. Specifically, they have to deposit 18% of their reserves to the central bank. Non-scheduled banks have no compulsion to do that, and they don't need to submit those weekly statements. Because scheduled banks operate under this intense scrutiny, they earn a very high degree of public confidence, whereas non-scheduled banks just don't naturally create that same broad public trust. And to really emphasize the high barrier to entry here, a bank can't just politely ask to be scheduled. It has to maintain a massive minimum paid-up capital and reserve fund. In Bangladesh, that number was refixed to 400 crore taka. That is 400 million taka. It's a monumental financial wall that essentially proves to the central bank and the public that the institution has immense financial stability before it's trusted with those sweeping privileges.
Yet, get this, despite these incredibly strict rules and huge capital requirements, the sheer volume of scheduled banks operating in Bangladesh actually stands at 57. Compare that to only 4 non-scheduled banks currently in operation there. I mean, that clearly shows how absolutely vital this scheduled classification is for banks that want to handle large-scale deposits, manage foreign transactions, and truly scale their operations across the national economy. All right, finally, we arrive at Section 5, the push for inclusion. Let's look at modernizing the financial ecosystem.
Let's explore why all this complex architecture, heavy capitalization, and rigid rulemaking even exist in the first place. The ultimate goal of this entire ecosystem, from the highest monetary policy of the central bank all the way down to the smallest microfinance loan, is to drive financial inclusion. It's about formally bringing people into the economy so they have actual access to secure savings and credit. It's about directly supporting small and medium enterprises, which, let's face it, are the backbone of job creation. And critically, it's about drastically reducing untraceable cash-based transactions to foster long-term, inclusive, and transparent economic growth.
And right now, technology is completely transforming how these goals are achieved. Digital and branchless banking is fundamentally rewriting the rulebook. By using mobile apps, internet platforms, and mobile wallets, banks can now expand financial access far beyond your traditional urban brick-and-mortar branches. They can instantly reach populations in the most remote rural areas, bringing them securely right into the financial fold. It's a real game changer.
However, as the system rapidly digitizes and scales up, well, it's not without its hurdles. Central banks and commercial institutions face massive, ongoing challenges. They are constantly battling to manage non-performing loans and navigate broader economic instability. They have to expertly manage inflation and interest rate fluctuations. And crucially, as millions adopt digital wallets, the entire ecosystem faces sharply rising cybersecurity risks that regulators must constantly try to stay ahead of.
Which leaves us with a final provocative thought to ponder. We've seen how meticulously structured these economies are, but as digital technology allows banking to bypass traditional physical branches entirely, expanding seamlessly across borders via mobile wallets, how will strict, historically rigid regulatory classifications like scheduled and non-scheduled evolve to keep up? Will the rules of the past century govern the financial inclusion of the next? It's a fascinating question, and one that central banks are wrestling with right now. Thanks so much for joining me on this explainer, and keep exploring.